If anyone asks me, Nataraj, what is the best strategy to implement for intraday trading? Without any secondary thought, I will reply it as opening range breakout. There are two important reasons behind it. Number one is that it is a simple and effective strategy to implement. There is no confusion, seedhi baat, no bakwas. And second important point is that it's a working strategy. I'm not saying it randomly. Based on the last 10 years verified historical data, I'm saying this particular point. I'm going to divide this entire tutorial into three parts. In the first part, we will be discussing about the basic and absolute essential part, which is required to understand the strategy and its a logic behind the strategy. And second portion is where I will be giving certain tips to enhance the performance of the strategy. And in the last section of this video, in fact, it's a very interesting part where we will verifying the strategy's performance by different moderations and by different variations. So if you are a trader who is interested to learn about systematic and professional trading, then this particular video is for you. Hi, my name is Nataraj. Welcome back to yet another interesting video. Let's get started. Opening range breakout AFL masterclass is now live in trading with nataraj.com. For those who don't know what is AFL is, basically the AmiBroker software file. You can download that from this particular course, and also there is a specific training included in the entire course that how you can use this particular AFL to backtest and also plot it in different instruments and also optimize and everything about that particular AFL. This is not about the strategy part I'm going to discuss in today's video, but this is specifically about the AFL. If you are interested, I'm going to leave the link in the description. You can check that out. And also I will be discussing more on this AFL in the last section of this video. First point is what is opening range breakout. So to understand it, we will directly get into the subject, basically the essence of this particular strategy, why this strategy works. There are two important points included in the statement of the strategy itself, opening range and the breakout. So let's assume that you are looking into the market at 10:15 a.m. That's basically 1 hour completion of the market. At any given point of time, if you observe, the initial hours of the market will be usually volatile because there are so many sentiments involved and many people are participating and they want to dump their positions, they want to get out of their positions, and basically the heat of the market will be more in the initial hours of the market. So once the market volatility subsides in the initial hours of the market, the range will be formed. Assume in this particular case, you are looking into the market at 10:15 a.m. That means 1 hour after opening of the market, you are looking into the market and you have two important levels here. Opening range high, opening range low. Basically the first 1 hour high and 1 hour low. Typically, these two levels acts as support and resistance. So opening range high acts as a resistance and opening range low acts as a support. Let's try to understand this with an example. Assume that I have shorted the market in the initial hours of the market because of some technical reason. In that particular case, typically where I keep my stop losses. So I keep my stop loss at the day high. So after completion of the 1 hour, assume I am keeping my stop loss, the buying market stop loss at the range high. So now market started to reverse and market again ready to approach and hit my stop loss. So when market triggers my stop loss, obviously market stop loss buy order will convert it into market buy orders itself. So when there are more and more market buy orders executed, we know that obviously market move in that particular direction. So if there is a more market buy orders, market will move in the upward direction. This is point one. And immediately when the market is moving aggressively in one particular direction, most of the people who have shorted the market, maybe they are not keeping the stop losses, but they try to cover their positions here because market moving in opposite direction. They don't want to be in their position. They start to cover their position. So in that particular case, it acts as a ripple effect. From one side, the stop losses are getting triggered at that particular level. And second important thing is that most of the people who are in the opposite direction of the trade are covering their position. So this acts as a ripple effect and we will get the momentum or the directional momentum of the market in one particular direction. This is exactly the logic behind why ORB strategy works, or basically any support and resistances works. And similarly, when the market approaches to the lower level, ORB low level, so then the possibility of market moving in the downward direction is quite high because more and more aggressive sell orders or basically market sell orders are getting into the market. Eventually that will lead in the downward direction of the market. Well, this is the essence and this is the importance behind opening range. And now comes the question, what time we need to consider, whether 5 minutes, 15 minutes, 30 minutes, because there are people who consider first 15 minutes itself as an opening range and they trade it based on that. And some people consider first 30 minutes, some people consider 1 hour, 2 hour, 3 hour. It completely depends on an instrument and depends on a particular style. So there is no thumb rule to decide the opening range. But one point I wanted to mention here. So look at this particular data. This data is taken from my book, Mastermind of Day Trading. So again, this book link I have given in the description. You can check that later. So this particular data suggests that among 3066 trading days and 3090 trading days in Bank Nifty, 64% of the time Nifty's days high and day lows were established well within the first 1 hour. And similarly, 70% of the time in Bank Nifty, the day high and day low were established within the first 1 hour. So what this data means, this is an important point to understand here. Basically, based on this only, we're going to define the opening range. So let's try to understand this with an example. Here I have taken the Bank Nifty 15-minute chart data. So this is a completed 1 day activity. Here we have a first 1 hour data as well and the entire range activity as well. So the data suggests that we are looking into the market after 1 hour and assume that market is breaking the first 1 hour high. So in that particular sense, there is a higher possibility that the low that was formed in the first 1 hour, okay, so the first 1 hour low that is becoming the day's low is quite high. So this basically means if the market breaks out one particular level in the first 1 hour, possibility of it is returning to the opposite level is quite low. So Bank Nifty it is 70% and in Nifty it is 65%. So this is a crucial data. So that's the reason we have a lot of importance for the first 1 hour. So this is why we are going to consider the 1 hour, the first 1 hour as our opening range. So this was about the opening range, and now let's try to understand the breakout. So in simple words, it is basically market moving beyond certain level. So in this case, we are considering opening range high and opening range low. Assume if the market is breaking opening range high, then we can call it as a breakout. If the market is breaking the lower level of the overall opening range, then we are going to call it as the breakdown. So in that particular case, if it is a breakout, the possibility of market making a directional momentum in the upward direction is quite high. That I have already explained the reason behind it. And similarly, if the market is breaking the lower level of the opening range, the possibility of market moving in the downward direction is quite high. So now comes understanding the strategy part. So far we have understood opening range and the breakout, and by combining this we can form the strategy. So entry is pretty simple. We will wait for opening range to form. Once the opening range is formed, we will take an entry when the market breaks out the levels, opening range high, opening range low. So assume that if it is market is breaking the opening range high, then we are going to consider it as a long trade. If it is breaking opening range low, then we are going to consider it as a short trade. And once the trade is triggered, once we are in a trade, we are going to keep our stop loss for the opposite level. For example, in this case, so the market opening range high has broken, and immediately after getting into the trade, we are going to keep our stop loss to the opening range low. Or you can also combine so many things here. You can keep your stop loss based on ATR. You can also add a percentage basis stop loss, which we will be discussing later when we are going to verify the strategy. So this is a basic strategy, and since it is an intraday strategy, you are going to square off your positions at the end of the day. So it maybe depends on your broker time, but typically 315 or 320 where you can close your position if your stop loss is not triggered. Strategy is simple and straightforward. You will wait for opening range to form. You will take the trade based on the breakout, and once you are in a trade, you are going to keep your stop loss to the opposite level, and then you will wait for market to trigger either to the stop loss or close at the EOD. Now comes the second portion of the video. So basically certain tips to improve the performance of this particular strategy. See, any strategy will work in certain environment, may not work in certain environment. As a trader, it is our responsibility to understand the working nature of that particular strategy. So specifically for opening range breakout, it works in two important environments. Number one, the volatility is heart of the strategy. If there is no volatility, for example, Nifty and Bank Nifty. So I will definitely choose Bank Nifty to implement this strategy because Bank Nifty is more volatile. So higher beta, we can call it as a beta, volatility is represented by beta. Higher beta stocks or higher beta indexes works better for this particular strategy. And second important thing is we need to also consider the liquidity part of it. Of course, it is important for any particular strategy, but this particular strategy is absolutely important because when you are placing an order, when market is triggering at specifically the support and resistances level, the liquidity plays a very critical role. So you should not be in a loss because of just the opponent party is not available. So liquidity and volatility is an absolutely important point to consider to implement this strategy. And third most important point is the limitation on number of trades, because just because you know the opening range and opening range low, you should not be taking multiple trades for the same instrument on the same day. So the limitation that I follow in this particular strategy is that one trade for one instrument for one day. That's the basic thumb rule. You should not be taking more than one trade on particular day on any particular instrument. So that is a basic thumb rule. The reason behind it is very simple. You should not be opting more trades. More trades means you have to pay more brokerages, more taxes, and all those things. You can avoid those particular fees and also make a profit out of it. And second important thing is that as per our probability study, market has to make its day low and day high in the first 1 hour itself. With respect to that, we are only going to opt for one trade for one instrument for one day. So these three important points are absolutely important to keep in mind to enhance the profitability of this strategy. Well, now comes the important point. It is my favorite portion where we will be verifying or we will be backtesting the strategy with the different modifications and variations. So I will show you the AFL as well, how it looks and how basically the overall parameters you can control all those things. So here we are seeing the opening range AFL. So this is an AMI broker software. If you don't know about it, there is a specific tutorial that I have made for a beginner, so you can check that. I am giving that particular link also in the description. So from the course that is available in the tradingwithnataraj.com, so from there I have downloaded this AFL. So once you have that AFL, you can see this particular chart. You can apply this to any instrument. So it may be crude oil, it may be a currency, it may be any particular instrument. If you have a verified data for your AMI broker, you can simply apply the formula on any instrument. So here I am taking an example of Bank Nifty. In this case, see this particular green line that you are seeing here is basically the opening range high, and the red line that you are seeing here is an opening range low. And now presently I'm plotting this opening range chart on 5 minutes. So assume, for example, let's say I'm taking 15 minutes. Okay. So in this particular case, this is a 15-minute chart and this opening range high and low can be controlled from the parameter. So if you right click and go to the parameter, and here we have several parameters to control the overall strategy here. So starting candle is where we can control the opening range. For example, if I given it as a 1, the first candle will be considered for opening range. If I want the first 1 hour range as to be my opening range, then I'm going to give it as 4, right? So if I give 4, you can see the first 4 candle, 1, 2, 3, 4. 4 candle overall high and low are now considered as the opening range high and opening range low. So I can plot it in 5 minutes. So if I do it in 5 minutes, for example, let's say this is a 5-minute chart, right? So I cannot say 4. If I want 1 hour chart, I should mention it as 12, right? So that's exactly what is happening. So 12 means the first 1 hour of the candle, provided that we are plotting it in 5 minutes. So this is completely a variable data. Based on that, you can plot the opening range with respect to your comfortability. And second thing is the limitation of the trade. So by default, as I said, I'm not going to trade more than one particular trade for one instrument. You can also increase it. For example, if I increase it, assume that if I'm making it as two trades for one instrument, you can see the long trade also opted here. Okay, so long trade also taken here, and also again when the market reversed, the short trade was also opted. Usually I don't want 2 trades. I can simply limit my trade to 1. Okay, and stop loss percentage also you can give. So that also option has given here. So basically it's a trailing stop loss. So how it works, if I make it as, assume that if I make it as 0.4 or 0.7 or something, okay, 0.5. Okay, in that particular case, 0.5% of that instrument will be kept as stop loss. So right now you're seeing a red line right here. The red line itself is a stop loss. Okay, so ideally I don't want to keep the stop loss for this particular strategy. Assume if I don't want to keep the stop loss, in that sense the opposite level itself acts as a stop loss. Okay, so by default that is a basic strategy, and exiting this particular strategy is very simple. Once the market breaks out, right? So in this particular case, market is breaking the high here, right? Market has broken the high and we have taken the long position, and we are by default we're keeping the stop losses at the day low. And once that particular low is triggered, we are out of the trade. Otherwise, we are going to exit the trade at the end of the market. Let's take a working trade example here. Here also the 1 hour range we have taken. So after formation of this 1 hour, at this point of time, around 12:50, market given a breakout here, and after that you can see we got the directional momentum. So in that particular case, the opposite level was considered as stop loss. Here stop loss was not triggered, and market we exited at 350. So That's basic the strategy. So similar goes with a short trade. Let's look into the short trade. One example of a short trade. Just give me a moment. Yeah. So this is an example of a short trade here. So basically here after formation of the 1 hour, the low was broken in the first step, and that's why we have opted as a short trade here. And then you can see, and also you can also see the information where we have shorted, where is our present stop loss, and what is the PNL, present PNL and all. The stop loss was not triggered, and at the end of the day we are exiting the trade. Since it is an intraday strategy, we need to exit or square off our positions according to our broking time. So typically at 3:15 is what we are considering here. Now let's try to backtest it with the different variations and different modifications. So how this strategy has performed, let's try to understand. Well, here I'm going to the analysis window of AMI broker. So here first thing is that I want to show you the setting. If you go to the setting, we are considering the 5-minute time frame. Okay, so we are testing it for the 5-minute and both long and short trades. I'm considering the initial equity or the basic starting capital is a 3 lakh rupees here, and most importantly we're considering a percentage of 0.01 percentage as a slippage. So slippage is very important thing, because basically you will not be able to enter into the trade for the defined range, so or for a defined level. So there will be some certain differences basically because of the spread, and that's the reason we have to consider the slippage as well here. So everything is considered, and with respect to this, let's try to most importantly we will also see the parameters. What is the parameter that we have considered? There are two types of entries. I forgot to explain that. So here the type of entry can be two type. One is touch, another one is closing. So what this means is that when it's very simple, touch means the market movement touches this high or low, the trade will be opted. That is one. And the closing basis is we will wait for the closing of the market. So we need to close. We want the close to happen beyond that range. For example, in this case, you can see I will keep the cursor here. And in this case, the long entry was at 38,179, which is the closing of that particular candle. So since we are considering closing as our entry, so close will be considered as an entry point. So if I make it as a touch basis, you can see 38,150, which is nothing but the opening range high, that will be considered as an entry. So typically in my personal view, so I will take it as a touch entry as the moment market triggers, the moment we don't wait for market to close, immediately we will get into the trade. Or if you are a trader who want confirmation, you can also wait for the closing of the market and then you can get into the trade. So let's verify or backtest the different variations of this strategy now. So in this case, if I go to the parameter, we are testing the touch basis entry, and starting candle is 12. That means the first 1 hour range. Trade limit 1. We don't want to opt more than one trade per day. And stop loss is 2%. I don't want any particular stop loss here. So that's the reason I'm making it completely maximum 5%. So in this case, I'm considering the opposite level itself as a stop loss. And remaining everything is basically the color moderations. You can change the ORB high color, ORB low color, and the style of that particular line. All those things you can change according to your comfortability. So let's try to back test it. I'm doing it for the bank nifty and one lot. Okay, so 25 is the quantity that I have considered to back test. So this is how the overall strategy has worked. Let's try to understand the report. Okay, so here the starting capital was 3 lakh, and this particular strategy for first 1 hour, so it is 48.12% accuracy. That's the basic win rate of the strategy. But most importantly, you can see this is one of the important point, right? So the profit factor is around 1.22. That means it has a positive edge. In the long term, the possibility of this system working in our favor is quite high, because it is getting more when the market is working. When the trades are working, it is getting more from the market. When it is not working, it is giving less to the market. So that's the reason it is in profit despite being 48.12% win rate. Okay, and this is how the overall chart looks like. So this is tested from 2000 I think 9 end, and so far it's more than 10 years of data, and this is how the overall performance of this strategy looks like. And one more important point I wanted to mention here, the drawdown is somewhere around 11.52%, which is very good. And let's say if I do it with the same strategy, nothing has changed. If I do it based on the closing, then what will be the result? So in this case, it is a working strategy, but the performance is reduced. So again, this depends on instrument to instrument. Some instrument will work better on closing, and some instrument work better on touch basis. It is, you have to decide that what works better for your comfortability. So that you have to decide. Again, the same strategy has around 48.48%, and it is a strategy which has a positive edge. And let's try to change the range. Okay, instead of 12, what if I consider 2 hours of the market as opening range? For that, I'll give it as 24. Okay, and let's backtest it. Obviously, number of the trades will be reduced. Okay, one more thing I wanted to change. Okay, now it's in a closing basis. I want to make it as a touch basis entry, and if I backtest it, this is how. So it is also working strategy with a less number of trades. And one of the interesting point, the strategy accuracy is also improved, and around some trades are reduced because we are looking into the market after 2 hours. We are waiting till 2 hours to get the opening range high and low data. In that particular case, the strategy works like this. Okay, so typically, as I said, if it is a volatile instrument and a liquid instrument, that is a better fit for opening range breakout. Well, that's it from my end. I think you have learned something valuable today. If so, why not to like this and share this with your friends so that they can also get benefit from it. And if you want to get the opening range breakout AFL along with the training of that particular AFL, now it is live in trading with Nataraj.com. You can check out the link in the description, and also the book and other information that I mentioned in the video. All those links I have given in the description. You can check that after completion of this video. And by any chance, if you are new to my channel, kindly consider subscribing to the channel. Also click on the bell icon to get the regular updates from my end. That's it for today's video. See you in the next video. Until then, take care. Bye bye. Jai Hind.